Welcome to this special episode of the Money Marketing Podcast, brought to you in association with Royal London. In this series, we're exploring key topics shaping the future of financial advice, from client conversations to regulatory shifts and beyond. Stay tuned as we speak to expert voices from across the industry, sharing insights, ideas, and real-world experience. Hello and welcome. Today's episode, I'm joined by Ilana Miller, Investment Development Director at Royal London. Thank you for joining me today, Ilana.
Oh, you're welcome. I'm happy to be here.
So before we get into the main part of this conversation, could you give us a bit of background into yourself and what you do at Royal London?
Yeah, so I'm the Investment Development Director at Royal London, working in distribution. So I work with financial planning and advice firms all over the country, working on various matters that affect their businesses, but largely focused on investment, retirement, and the behavioural side of supporting clients through those decisions.
Okay. As the Investment Development Director, I think you're best placed for this particular discussion we'll be having today, as we're going to be covering investing resilience. So your recent article touched on that common don't panic advice, which is always something that you see from a lot of people with investment background. So in your view, why is it so vital for advisors to first address the emotional side of a client's reaction to market swings before delving into the figures?
So, something I referenced in the article and in previous LinkedIn posts have said that I think saying don't panic to someone who is clearly panicking is the equivalent of saying calm down to someone when you're in an argument. And that is often not going to be well received. It can even make things feel worse.
Yeah.
So when someone's emotions are really dialed up, it's often referred to as being in a hot state. So taking a moment to listen and understand often helps lower that temperature, get closer to being neutral and making the more rational decisions. Because, financial professionals are managing real people with real emotions. And when we jump straight to charts, numbers, facts, we miss that important job of helping somebody feel just heard and reassured. So I think I like these sort of 3 steps, and I talked about those to help us remember to address that emotional side in order to help agree a sensible, thoughtful way forward that everyone can feel good about. And that is acknowledge, contextualize, and personalize. So, firstly, by acknowledging that emotion, you're listening, understanding, showing genuine empathy for a client's concerns. Before getting into the facts goes a long way to help them back to that mindset where it's easier to make rational decisions. And then it's also easier to put it into context by illustrating that volatility is a normal part of how markets function over the long term. As we all know, history's shown that investment values tend to recover. And I've seen firms all have their favourite ways of doing this. And it usually won't be the first time they've done that, having to create that context, of course, because I think even though it is not the first time, it's never going to be the first time this has happened. It always feels that way to clients. And that's because even though the drops aren't unprecedented, quite often the reason for the drop is. So it's really important to help the client put that into context before finally personalising that. So that is just providing a bit of perspective by looking at what it means specifically for each individual client's situation and plan. And I've seen a lot of firms bring that perspective just by clarifying whether the client's circumstances have changed, have their risk or goals changed. And, often the answer is going to be no, and that helps them bring that back. So, and I think, finally, I guess, longer term, it is just about building that investor resilience by educating clients on an ongoing basis, how to act well so that these, and through their investing lifetime, so these bouts of anxiety become less frequent and less severe.
And we're probably going to touch on all of those things and expand on them a bit. But beyond simply listening, what practical conversation techniques can advisors employ to truly connect with a client's anxiety and help them feel understood when markets are turbulent? There's always a headline that's going to probably catch everyone and knock them off their feet sometimes.
Oh, absolutely. Oh, daily, I think.
Yeah.
Especially with social media now as well.
Exactly.
So, I think to truly connect with the client's anxiety and help them feel understood, firstly, I'd make sure that you actually do understand what they're feeling. And I've certainly made that error of assuming I know what somebody means. And I've also experienced it myself the other way around. And no one's going to feel good when someone responds with, I totally get what you're saying, only to go on and demonstrate that they totally do not get what you're saying. So I think it's sensible to start by naming the emotion and check that what you think is going on is right. So, for example, saying, it sounds like this is making you feel uncertain, or this seems to have clearly shaken your confidence. So reflecting back what you've heard can be a powerful way to confirm, show you understand before then moving on and exploring further to find out what is causing that feeling. What is their real fear? Is it about running out of money? Is it just the noise of the headlines is shaking them? Is it something else? Once that's understood, we can then explore that, anchor them back to something solid, which is normally going to be their plan, their values, their goals. And that then just helps zoom them back out, that longer timeline, out of this one day, and take that perspective away from that panic and back to their purpose.
Mm-hmm. And you also mentioned creating context. So how can advisors effectively explain that volatility is a normal market feature, an uncomfortable one for sure, but especially to less experienced investors without sounding dismissive of their immediate concerns? Because, sometimes it can feel like you're being condescended upon or something.
Yeah, and I've certainly heard that feedback. And it's hard if we all know something very well, it can be hard to remember that it can be quite scary for other people. But I think most financial professionals will be well equipped in dealing with exactly this situation. And I think first by letting them know that it's really common to feel that way. That's one of the valuable benefits of working with an advisor or planner, that they can help educate, inform and coach clients throughout their investing lifetime. Mm-hmm. So not just to enable them to act in their own best interests, of course, but it's to feel good along the way. And I would love to see that link between market noise and client confidence, permanently broken. Mm-hmm. And, you mentioned there about, so it's not being dismissive, and although financial professionals know volatility is completely normal, in fact, we know it's necessary. When you're someone experiencing it for the first time, or where it isn't part of your day-to-day life, or there's a seemingly new reason for the volatility, it doesn't feel normal at all. So that you asked about creating the context, and I don't think that necessarily means getting into all the technical details. It's more about providing the background on the specific reasons for the current market volatility, while showing how it fits into the bigger picture, so they understand why they should remain relaxed and take a longer term view. And I think some brilliant ways of doing that. I love visuals. Any opportunity, whether to draw a picture, show a great visual. And there's all sorts of ones used out there. I know with some firms, the wall of worry is a really popular one. So many organisations have a version of that, which is a chart just showing how markets rise over time using a specific index, usually over a significant time period, and highlighting the wide variety of shocks over that period. Others like you have seen them, I'm sure, many times, the bull and bear run charts, to create that context. Intra-year decline charts, and there's all sorts of great visuals to help create the context and use data in a really engaging and easy to understand way.
Okay. And could you touch upon the importance of illustrating time in the market, not timing the market, maybe with an example of how advisors can make this tangible for clients?
Yeah. So that statement is one of those investing mantras that's been around forever.
Okay.
I started 30 years ago, nearly 30 years ago, and I've heard it, I think, from day one.
Hmm.
But there's nuance to consider that's going to be out with the simplicity we're looking for right now. But let's just assume that the investment is suitable for the long term. The challenge for advisors is then making this investment concept resonate and real to every client, like you said, with how do you make that tangible? And I think one way to do that is just shift it from the theory to a real experience.
Hmm.
So, you'll have seen many people like using visuals that show the impact of missing, X number of best days. But I think that there's some challenges to that. So personally, I like to use the strong visuals that really show the impact of compounding itself and how powerful it is.
Hmm.
That does really help demonstrate how important staying invested is to success. And those compounding charts can also really help illustrate the damage caused when compounding is interrupted, and also the importance of that consistency. And there's a couple of other, let's go a bit more left field, things I like to focus on to help clients stay invested when I'm working with firms. And that is, what are the triggers that would cause that to happen, and how do we manage or avoid them? And also, do they understand holding periods? People would say they do, but then we see that kind of fall apart in volatility. So starting with triggers, I'll take one example, that can simply be how often someone looks at the valuation. Just reducing how often you look can be very effective. And a simple way I like to do that is just produce 3 charts off the same index over a year. So they all show the start to end journey over a year, but one assumes daily valuations, one's monthly, the other's annually. So, and this is a serious investing term I'm going to use, the wiggliness of those lines will look very different depending how often you check, but they all end up in the same place. So annually is always going to be one straight line, and more times than not going upwards. So it's a great, simple way to show how simply just checking over more suitable time points smooths the ride. And I often joke that anyone could add a smoothing facility to their portfolio at no cost just by checking it less often. So that's one of the ways I would try and reduce the frequency people look. And I also mentioned holding periods really helps with that too. When people get that and the penny drops, that's really effective. But showing lots of data can be overwhelming, and actually it can be quite boring for many people. So I'll often take the concept that I want to land and put it into a more familiar context for the client. So when we're thinking of holding periods, one I've found to be really effective for that scenario is to use an analogy of the Christmas turkey. Unless I'm talking to my family who are all veggie. But for a lot of people, I'll say at Christmas, people pick the right turkey. You know when you need it for, what you want it to look like, and it's going to need, say, 3 hours in the oven, however long. You're happy with that. You might give it the odd check at appropriate intervals. You certainly do not open the door after 20 minutes, beside yourself in a panic, phoning the butcher saying it looks too pale, it's inedible, it's not what I expected, and take it out and put something else in. People laugh at that. They laugh at the thought of that. We think it was ludicrous. And that's because we understand the holding period of a roast turkey. So we assess it at the right times, and we wouldn't take action that risked damaging the outcome we want. But unfortunately, people don't do that with their investment portfolio. They check it far too frequently. They react over inappropriate time periods, and they risk damaging the outcomes. And so I think something quite simple like that, a number of firms have said they find the turkey, other such examples, just helps in that moment recenter certain clients back to those principles they were coached on in calmer times. And so we're looking to produce some more of that sort of content later in the year.
That I really like that analogy. I'm definitely going to be thinking about that now in times when I'm like, oh, I want to buy this now. But then, why would I open the oven when it's not ready?
Exactly.
I like that. I like that.
Yeah. I like anything is not ready yet. You can use, I think about it, I sometimes use it about a flight. We assess all of the things we understand, we assess them over the right period. A film, a book. If you get on a plane and you were flying to, I don't know, whether it was Spain or South Africa,
Yeah.
you know how long the journey will take, and you're just comfortable until you land. You don't look out the window after 40 minutes and say, this looks terrible, it doesn't look like the brochure, there's just water everywhere. Get me off, I want to pick another destination. That would be really inappropriate time to be making those decisions. So yeah, there's a number of things you can use.
I like that. So talking a bit more about building long-term resilience, the concept of building investor resilience is obviously key. So what are one or two common behavioral biases that you have seen that derail investors during volatility, and how can advisors help clients navigate these?
So I'm going to have to, this is a hard for me because I love this subject, and I think behavioral biases are just so central to who we are and how we behave and how, you know, we can act, you know, how we can help or harm ourselves really.
Yeah.
But so that we're not here till nightfall, I will just pick a couple for now. So let's talk about loss aversion and recency bias, I think. So with loss aversion, we know that a loss has a bigger effect on us psychologically than a gain, and the exact figure differs from study to study, but we're thought to feel losses about twice as strongly as gains. So when we're talking about biases that will derail investors during volatility, that is a key one, because because of that feeling, that real pain that it causes, many people look to avoid losses as much as possible. And there's been some research that states that the impact of loss aversion is reduced by investing in a multi-asset portfolio. And that's because it's less immediately clear what all the individual holdings are doing and how they're performing at any one time. If you're using an off-the-shelf multi-asset fund or portfolio, you don't then have the option to be trading in and out of the individual ones not doing well. However, it does still remain an issue that makes diversification very challenging. And that's because with loss aversion, we know people overly focus on losses. However, if you're well diversified, there should always be something underperforming. So there likely is always something underperforming. And there's even a phrase that says diversification means you'll always be apologizing for something. So that's, and I hear it, we get phone calls if at any point, no matter what the performance is doing, they'll go, what is it? What is not performing at the moment? People want to know, rather than understanding that it is a feature, not a bug, of diversification. So for that one, you know, something that firms just really have to go back to basics on, because it's a pretty central philosophy of most portfolios, reminding that exactly that, it's a feature, not a bug, nothing's been lost or sold, the same number of units are still held, and re-educating on diversification. And I use another story for that, about a well-packed suitcase that I use in sessions with firms, and it can be a really easy way to introduce why we're diversified. Before you might move into some, you know, really great relevant data like the patchwork quilt, the well-packed suitcase story can help. And the other one, recency bias, you know, that one tricks us into believing that the recent past will keep happening, and particularly dangerous right now as well. So, you know, if markets are falling, we assume they'll keep falling, and vice versa. So for that, some of what we've already discussed so far, you know, would really help with that. Showing bounce back stories, helping clients zoom out to years and decades rather than days. But in all cases, we need people to have an awareness of behavioural biases, how they impact decision making. And part of that is helping clients understand triggers such as social media, so they can recognise when it's happening and help rewire how they think under pressure. Yeah.
I think we just need to rewire our minds when it comes to social media posts in general anyway.
Yeah, absolutely. There's a phrase, is it from The Doors, I think, that says control the media, control the minds. Because it is so powerful what we read, and even if we, you know, tell ourselves to be careful, the way that algorithms work, the more things that we look at that worry us, the more of those will be fed. And it gives us a false sort of narrative or perspective on what's actually happening, again, which is why the planners and advisors, the people that are fortunate enough to have those ongoing services, it is such a hugely valuable resource and service to have.
Yeah. I've recently really taken on board an internet phrase, which is to go touch grass, which is usually something they tell someone who's too online, go outside, touch some grass, live in reality. So brilliant. I find that's helped me.
That's slightly triggering for me, Kimberley, because it reminds me of when I was back in a boot camp and when you were doing squats. That's what they basically
tell you to touch grass. Yeah.
Grass. Get that low down. So, but no, it's a good one. I like it.
Yeah. And for clients approaching or in drawdown, volatility presents unique anxieties. So how can advisors proactively prepare these clients and reassure them, for instance, by referring back to their cash flow models or discussing withdrawal strategies?
Yeah, so that's a really good question, as market volatility can present a much more significant issue for clients who are looking to retire shortly or in drawdown because of that double whammy of worrying about market falls. So you've got that to address, but also the immediate income concerns.
Yeah.
So, but we know the risk of moving assets into cash outside of what's been agreed, of course, is effectively locking in those losses, and without the option to pay in further contributions for many retirees. So for these clients in drawdown, depending on the circumstances, simple reassurance may be enough. And many will do that by, as you say, referring back to the cash flow model, and they'll illustrate the falls that were built in. So to demonstrate that, bad weather had been planned for before it rained, showing what those were and showing how the plan still remains sustainable for that client's needs. And reassurance can also be given that their particular withdrawal strategy is designed to ride out market cycles, assuming, of course, it is. But that is what many withdrawal strategies have been tried and tested and chosen for a specific reason. And I guess finally, although it's not an option for everybody, for some clients, it may be exploring ways to reduce the number or size of withdrawals where it's suitable and possible. But, in some cases, it's going to be a combination of one or more of those things. But more generally, it's fair to say that drawdown clients are likely to need more frequent check-ins during volatile periods to help them feel informed, in control, and safe.
And the market landscape is always evolving, as we've already highlighted earlier. So how does Royal London view the importance of multi-asset solutions, potentially including assets like commodities, in building portfolios that can weather different economic conditions?
So we believe it's important to have broad diversification across asset classes beyond just equities and bonds. And we are very vocal about that. And if you look at how asset classes perform across the business cycle, you can see why that broader diversification is required. So thinking back to 2022, which was a challenging year for markets on the back of an inflationary shock and central banks raising interest rates, we saw both equities and bonds lose value. And that isn't unusual during periods of slowing economic growth and rising interest rates. So as a stagflation, as it is known, being more broadly diversified and including asset classes like commodities, which provide protection against inflationary shocks, meant we were able to better protect clients compared with simple equity bond portfolios. And we believe the post-2020 world has transitioned from long deflationary cycles to shorter, more volatile cycles. So we see more frequent spikes in inflation compared to previous decades. So the benefits of broader diversification will be felt more frequently in the coming decades. And as a customer-owned organisation, we have to think very carefully about how we get the best outcomes for clients. And that is something that we believe we are going to see in future years.
Okay. And going back to your article, which a lot of this has been pulled from, You highlight the potential benefits of true active strategies in challenging markets. So could you briefly explain how active management can add value compared to passive approaches during such times?
Yes, you always feel like you might have to put your safety gear on before talking about active and passive management, don't you? But we don't believe there is such a thing as passive in multi-asset. The largest contributor to performance is asset allocation. So deciding which asset classes to include and the allocations is an active decision. And everybody that's investing is, at least initially, making that decision. So once that decision has been made, you're then deciding whether to include passive funds, active funds, or a blend to match the asset allocation that you're looking for. And then it's, are you going to have an active tactical asset allocation over that, or is it going to regularly rebalance back to fixed weights? And, unfortunately, the conversation around active and passive in recent years has become quite binary in some quarters, but that can miss the point. And with so many variables, for us, it makes sense to be pragmatic, as often the conclusion is going to be much more nuanced. And that is why we use active approaches where it adds value for our members. So to bring that to life, go back in time to 2022 again. That was a challenging year in markets on the back of that inflationary shock and central banks raising those interest rates. And our active decision to be more broadly diversified protected clients. Then from that tactical asset allocation perspective, where we were being active, meant we were largely underweight equities and bonds and overweight commodities and cash. So that active decision to be more broadly diversified meant we were able to protect our members from the severe drawdowns that some of our lesser diversified peers experienced. So, going back to what I said at the start there, given what we've discussed about the initial decisions that everybody needs to make when they invest, I think the question shouldn't be, do you want to be active or passive? It should be, how active are you going to be?
Okay. And finally, Ilana, how can advisors best demonstrate their indispensable value when guiding clients through these uncertain periods, reinforcing the benefits of ongoing professional advice, especially in the current times? I think they can really make a case for themselves.
Yeah, absolutely. We know that periods of market volatility can be extremely unsettling for many people. And in reality, coaching we've seen and education is taking a huge step forward, but people being unsettled by it is going to continue. But really, it is just another opportunity for firms to demonstrate the value of personalised financial planning and ongoing services. Financial professionals provide the expertise, emotional and behavioural support that clients really need in times of uncertainty, which improves their well-being and financial confidence, and really, ultimately, just helps them enjoy the life that they've planned for.
Yeah. Well, thank you so much for speaking with me today, Ilana. This was a really great conversation.
Oh, thank you. Really enjoyed it. Thanks, Kimberley.
Thanks for listening to this episode of the Money Marketing Podcast in association with Royal London. We hope you found it insightful. If you enjoyed this conversation, be sure to follow and share the podcast, and join us next time for more expert takes on the topics that matter most in financial advice. See you next time.